The Money School podcast is brought to you by Anchor, where you can create, distribute, and monetize your own podcast for free. You can create on your computer or, like me, on your phone. Anchor will distribute your podcast on Spotify or Apple or wherever you listen to podcasts. You can make money from your own podcast with no minimum listenership. It's everything you need to make a podcast all in one place. Download the free Anchor app or go to anchor.fm to get started. Welcome to the Money School podcast. Today is Friday, August 7th, 2020. I graduated from college in 2009 with a finance degree. In my senior year, I watched Lehman Brothers collapse and the financial markets begin to go into crisis mode. The stock market and the housing market, everything was so different then. When I was looking at jobs, I was now competing against master's degrees and people that were 40 years old that had 20 years of experience in my industry, and I was coming out as one of thousands of finance degrees in my state alone. While I've always loved the stock market and finance, when I graduated from college, my heart was in real estate. I began selling real estate June 1st, 2009, and the housing market then and now is quite a bit different. And I wanted to share my journey from starting to sell real estate on my own in June of 2009, which the bottom of the crisis was March. So in hindsight, every day of the market has only been up for my entire career. And things have changed, and credit has changed, and the industry has changed, as long as as well as the technology. And now that I own and run a brokerage with 15 brokers, and we do about 100 million per year in production in Oregon and Washington, we see such a wide range of transactions and situations that we have insights into just what's going on with the real estate market and what buyers and sellers are facing and what realtors are seeing. And I wanted to share some of that, as well as some of the principles that have created a bunch of wealth for my clients. There's going to be a lot of real estate heavy content, just given my experience, my position owning a real estate brokerage. One of the questions that we get constantly, especially in 2020, is, do I buy now or should I wait for the market to cool off and correct? And to be honest, I've been getting the same objection since 2012, 2013, 2014, when the market still felt ugly and people had crisis really recent, fresh in their mind. Now in 2020, the concern is prices are at all-time highs, and there's a shortage of housing that's driving prices up, and we're facing so many unemployed with the coronavirus, um, just impact on the economy and what's happening with, people that are renting. Are they paying their rent? The rent moratorium, or the eviction moratorium, and some of those rules have expired. The $600 a week has expired. As we sit right now on Friday, they haven't reached a deal to extend any of those benefits. They're going to compromise and do something, but still, there's such a fundamental difference in the haves and have-nots in our economy in terms of who's participating in the real estate market and the stock market and who's not. Um, so the question, is now the right time to buy? The answer is depends on where, and it depends on what kind of real estate. If you're buying residential real estate, the market is growing at 7.7% everywhere in the country. That's as Q1 2020 by the NAR. We should have Q2 numbers here anytime, and those will be pretty interesting to see what our growth has been. But 7.7 is a number that has been annualized back for quite a bit. Oversimplifying a bit, but pretty close. Mortgage rates are at 3, and housing prices are growing at 8% year over year. If you can borrow at 3 and compound the entire value of the asset at 8% per year, you're going to create a ton of wealth over time. The average homeowner anywhere in the United States has gained $53,000 in equity over the last 36 months through the first quarter of 2020. That's almost $1,500 per month for owning where you live versus renting it. In Portland and Southwest Washington, in our core markets, that number's $74,000 or almost $2,100 per month. If you bought a house in Portland 5 years ago, the average equity gain is just under $153,000. The national average is $87,425. The rule of 72 is a shortcut to estimate the doubling time for any investment. If you divide 72 by 7.7, that means on average you'll double the value of your home every 9.3 years. Of course, these are just historical averages, and even though they're recent historical averages, we need to look at the bigger trends that are going on, largely around employment and what's happening with the workforce in this country. Uh, what's happened, one of the major changes that has happened with COVID-19 coronavirus, um, is not just work from home, but work from anywhere. And that's going to be a trend that I think will stay around no matter what over, at least the next several years. But we're seeing it in a real way as, New York's condos and co-ops, they're down 57% in July, $4 to $10 million, all real estate in New York is down 75%. That's a ton of urban flight. San Francisco is feeling it to a lesser degree, but what you're seeing is the workforce decentralize. And as these employers can now, they're finding the best talent everywhere instead of paying a huge premium to bring them to Silicon Valley and, pay, 20%, 30% premiums on their salary to get the talent nearby. Now that they're working remotely and these tech companies have declared, we're going to work remotely for, maybe forever. We're seeing those, the talent assets, the employers, the contractors are moving to states that have lower taxes. And that's happening from Elon Musk to Joe Rogan to, all sorts of our clients that are moving from, California that has 13.3% taxes. And, looking at somebody like Elon, all of his compensation is in stock options. And his first tranche of that, he paid $104 million to California. And over the course of, his 50 something billion-dollar compensation package with Tesla, if he exercises those in Texas, he's going to save $7 billion. So Joe Rogan has at least $100 million deal. It's probably $300 or $400 million from what people that actually know what the deal is. It's a lot more than 100 million. When you have that much money saving, 13%, if you're not getting the benefit of being in the city or the urban center, you move to where the taxes are cheaper. And we're seeing that happen with, that's one of the reasons why Nevada is booming, Washington is booming, and all of these low tax areas, Florida, all these people moving from New York, these high net worth people, they're moving to, largely to Florida, um, some to Texas, but California is moving to Texas and Nevada in a huge way, and they're also moving north to Washington, but to a lesser degree. Um, the West Coast states are the amount of foreign dollars is just down to a 7-year low, and it just continues to slow down year over year. We're getting less foreign investment and we're getting less foreign dollars. That's probably going to continue to remain the same until at least the trade war stuff gets situated with China. But we used to get a lot of foreign dollars that were anchoring, especially the West Coast housing markets, but that money is largely gone now. So employment is really key to what is going to drive these markets. And now that the workforce has become decentralized, taxes and the environment and the quality of life and the affordability of the real estate is driving people to move to different parts of the country and live in more square footage. So that's a trend. If you listen to CNBC, they'll beat it to to death that people are moving from cities and they're moving to the suburbs. And yeah, that's happening. People are moving out of big cities, and condo prices and apartment prices are largely getting crushed. And single family homes, there's a huge shortage of them, and everything is in a bidding war. So that leads to the next part of, is now the right time to buy? It depends on where you're at. If you're going to buy a single family home and you're going to fit into that macro trend, I think now is the right time to buy, even though prices are higher. If you want to live in an urban center in a city that's denser, there's probably going to be a little bit more downside, and there's going to be some more adjustment of those markets in terms of the flow of those dollars and the demand for those real estate, assets. And just it really comes down to, if you're running a business, what kind of employees can you attract? And if you're not attracting them locally, you can find better people for cheaper all over the place. And that's why stocks like, you know, Zoom and Microsoft and Salesforce, these stocks that help people work from anywhere, are booming. And I don't think that that's a trend that's going to reverse. So if you're buying in an area, or you're looking to buy in an area that's, not just suburban, but, less shared walls and more space to breathe and more yard, those types of housing starts are going to continue to sell through really quick. The problem is that the price for land is so expensive, and the overhead for builders and all of the material costs for these builders, that hasn't gone down. So the cost for them to build a home in the United States in general has gone through the roof, mostly because of regulation. And then you have builders that are building houses that are largely in the wrong price point. And the single family, the real winners in this market are people that have bought in the last 5 years and have refinanced now at 2.5, 3%. We're getting people that are refinancing, in the mid twos, and they're up a double in their house. And those are the people that are really winning in this market. Getting in with a new purchase or acquisition, um, the interest rates are great, but they're great because the demand for money is lower, and also because people are borrowing less because they're rolling equity over. And when you're in a bidding war with 10 other buyers, two of them are cash and three of them are 200,000, $300,000 down, and then you have, call it five or six of those 10 offers are FHA, VA, low down payment buyers that are really getting squeezed, and they're not even really getting to participate in the market yet. And that's what's going to continue to drive prices higher, is there's not enough supply of homes in the price categories that people need. And that in itself will make the problem worse, because that's where you get the biggest price inflation, is in the lowest part of the demand curve. So the average housing price in the country is about $270,000. In Portland, in Southwest Washington, in our market, that's $400,000. Anywhere under $400,000 in our market is in multiple offer, and largely going to people that have already participated in the housing market and have a ton of equity to roll over, and they have access to more capital to put down and to be more attractive as a buyer. So until we start working through all of those buyers and get through to, from a real estate perspective, a higher risk buyer that has lower down payment, and they can finally start buying houses at market value and not having to pay a premium just to get the buyer to, or the seller to, accept their offer, the housing market's going to continue to grind higher. And that's going to be accentuated in markets where the taxes are low and the environment is clean and housing prices are generally affordable. You're going to see just a huge amount of demand over the next 3 to 5 years. The average person lives in their home for 7 years. That's a little lower now. That's a historical number. You're looking for the next 3 to 5 years of where jobs are going to continue to grow, where schools are strong, and where there's going to be a demand to live. Those markets are going to remain the same ones that are in this post-coronavirus trajectory. The ones that have started to do well in the last 3 months are going to continue to be the ones that do well. And the markets like New York and San Francisco and LA have a lot more legwork and challenges ahead, in terms of building equity. Even Portland versus Southwest Washington is just across the river, but there's a 10% state income difference between Oregon and Washington, and that drives a huge amount more growth to the Washington side of the river. And just having that extra tax there, when companies are talking about, okay, we're going to restructure our entire company and we're going to move our headquarters around, when they're looking at that corporate tax rate, it just eliminates them from consideration. So I really think that the Texas, Arizona, Nevada, Washington, Tennessee, Florida combo, I mean, of the low tax states that have moderate, you know, I don't know if Arizona and Nevada are moderate climate, but at least they're sunny. Those markets are going to continue to boom. And if that's where you want to live, then yeah, right now is the time to buy. A couple of quick tips for buyers in a really competitive real estate market. It's always important to be pre-approved, but now more than ever, you have to get your money right and have a full pre-approval ready to go by the time you start looking at homes. Some realtors are going to be more lax on if they're going to require that before you go out and show. It's in your best interest to get your money right and to have this pre-approval letter rock solid so that when a listing comes up and it's on the market for 2 days, you already have your pre-approval letter, you know how much closing costs you need if you need anything, and your realtor can now go to the listing agent and vouch for you to a higher degree because your money is in order and we're not rushing after the fact to get you pre-approved and sorting out all the details in terms of what you need for your concessions, especially if you're a lower down buyer, if you're in the VA, FHA, you have to be very prepared and have an expectation that you might have to overpay slightly for the right house, but that will be the determining factor between if it's just the right one or some other house. If you're not willing to overpay for it slightly, then it's just not the right house. Get pre-approved, give your realtor the best chance to pitch you and vouch for you, and be ready to spend a little bit more if it's the right house. And a few tips for sellers on how to maximize your market position and create optimum leverage for your deal making. When the market is undersupplied in homes, we're in a seller's market. One of the ways that you maximize that position is to underprice your house just slightly. When I say just slightly, I mean 1 to 2%. What happens when you underprice slightly is you create urgency. And when you create urgency, you create the fear of missing out. And when you have a bunch of people fighting over a house that you can only sell once, if you have 10 offers, you can only sell the house one time. So those other 9 buyers that didn't get it are now more motivated looking at other homes. So when you come on and you're priced right, and your price may be a little low, and you create that buzz, and you become a trending hot home on Zillow and Redfin and all the syndicated players, you're you're going to jump out and you're going to create more buzz that will allow you to capitalize on your market position, not just pricing, but all of your other terms, down payment, closing time, rent back, all of the other things that maybe make the deal safer for you or de-risk because now their appraisal addendum is adjusted in your favor. There's a bunch of ways, depending on where you're at, that your realtor can structure the terms that when you're priced right and you have a bidding war, look at all of the other factors that are going into your final decision. After looking at the entire market and doing this thousands of times, the way to get to the best outcome is to underprice slightly, hire the right realtor that will blow your marketing out, and then let the market be efficient and take care of itself. Thanks for listening to the Money School podcast. I'm Nate Brantley. Become a Money School member at patreon.com/Nate Brantley.